Alright, let's talk about something that sounds incredibly complicated but is actually simpler than you might think. Forex trading. Forex stands for foreign exchange. It's trading one country's currency for another. Think about when you travel abroad exchanging dollars for euros or yen dollars euros yen, you are participating in the Forex market. Big traders do this on a much larger scale. The Forex market is the biggest financial market in the world. Trillions of dollars are traded every single day. It operates 24 hours a day, 5 days a week, so it offers huge opportunity. First things first, let's get the basic vocabulary down. Building a solid foundation with these core concepts is the most important first step you can take. Without them, navigating the Forex market is like trying to sail without a compass. In Forex, you are always trading currencies in pairs. This is because you are simultaneously buying one currency while selling another. Think of it as a financial tug-of-war between two economies. For example, one of the most popular pairs is the EUR-USD. That's the euro versus the US dollar. Other major pairs you'll frequently see are the British pound versus the US dollar, or GBP-USD, and the US dollar versus the Japanese yen, or USD-JPY. The first currency in the pair is called the base currency, and the second one is the quote currency. This is crucial. The base currency is always the basis for the trade. When you buy a pair, you're predicting the base currency will strengthen against the quote currency. When you sell, you're betting it will weaken. The price you see for EUR-USD, like 1.0800, tells you how many units of the quote currency it takes to buy 1 unit of the base currency. In this case, 1 euro equals 1.0800 US dollars. Next up is the term pip. A pip stands for percentage in point, and it's the smallest standard price change a currency pair can make. It's how we measure our profits and losses. For most pairs, like the EUR-USD, a pip is the fourth decimal place. So, if the price moves from 1.0800 to 1.0801, that is a 1 pip move. A key exception is with pairs involving the Japanese yen, where a pip is the second decimal place. To allow for more precise pricing, many brokers now also quote in fractional pips, often called pipettes, which is the 5th decimal place for most pairs. So, how much money is 1 pip worth? That depends on something called the lot size. A lot is simply the size of your trade. The most common sizes are the standard lot, which is 100,000 units of the base currency, the mini lot, at 10,000 units, and the micro lot, at 1,000 units. The lot size you choose directly impacts the value of each pip. For a EUR-USD trade, a 1 pip move on a standard lot is worth about $10. On a mini lot, it's about $1. And on a micro lot, it's just 10 cents. As a beginner, starting with micro or mini lots is a wise way to manage risk while you're learning. Now we need to talk about a very important and potentially dangerous tool in Forex: leverage. In simple terms, leverage is like getting a loan from your broker to control a much larger position than your own capital would allow. The capital you put up is called margin. For example, if your broker offers 100-to-1 leverage, it means that for every $1 of margin you put up, you can control $100 in the market. This allows traders with smaller capital to take meaningful positions. However, and this is the most important part, leverage is a double-edged sword. It amplifies your losses just as much as it amplifies your profits. A small market move against you can wipe out your entire investment very quickly. Respecting leverage and using it cautiously is not just a tip, it's essential for survival and long-term success in trading. Okay, let's get to the good part, the strategy. We're going to keep this incredibly simple, because in trading, complexity often leads to confusion and analysis paralysis. Our goal is clarity and confidence, not a cluttered chart. This strategy is designed to take about 10 minutes of your time per day. That's it. Because we'll be using a longer time frame, you can check your charts once, make a decision, and then get on with your life. It's trading that fits your schedule. We're going to use something called moving averages. A moving average is a line on your chart showing the average price over a set number of periods. Its job is to smooth out the chaotic price action, making it much easier to see the underlying trend. For this strategy, we will only use 2 moving averages. That's it. Specifically, we'll use exponential moving averages, or EMAs, because they react faster to recent price changes. We'll use an 8-period EMA, which is our fast line, and a 21-period EMA, our slow line showing the more established trend. Here's the core concept. When the faster blue 8 EMA crosses above the slower red 21 EMA, it's a signal the trend may be turning up. Look to buy. This suggests short-term momentum is strengthening. Conversely, when the blue 8 EMA crosses below the red 21 EMA, it's a signal the trend may be turning down. Look to sell. This crossover is our primary trigger. The best time frame for beginners is the daily chart. Each candle equals one full day of trading, which filters out market noise and gives clearer signals. This leads to our first step. Identify the crossover. Step 2 is crucial. Wait for confirmation. Don't enter immediately. Wait for the daily candle to fully close. This helps validate the signal and avoid false alarms. Step 3 is to enter and set safety nets. For a buy signal, you'd enter with 1 micro lot, a small position size perfect for beginners. Then, immediately set 2 orders. First, a stop loss, placed just below the low of the confirming candle. This is your non-negotiable exit plan. Second, a take profit, set to a risk-to-reward ratio of 1 to 1.5. This means for every dollar you risk, you aim to make $1.50, a cornerstone of profitable trading. The single most important step you can take right now is to open a demo account. A demo account is a practice account offered by virtually every Forex broker. It uses real live market data, so you're seeing the exact same price movements as professional traders. The only difference? You're using virtual money. This means you can experience the thrill of trading, test your strategies, and make all the beginner mistakes without risking a single cent of your hard-earned cash. Think of a demo account as your personal trading simulator. It's kind of like a flight simulator for a pilot. No airline would ever let a new pilot fly a real plane full of passengers without hundreds of hours in a simulator first. Why? Because flying is a high-stakes skill, and so is trading. Your demo account is where you'll learn to navigate the platform, understand order types, and most importantly, begin to manage your emotions in a live market environment. Treat it seriously, as if it were real money, and it will be the best teacher you ever have. Now let's talk about protecting your capital. The most fundamental rule of risk management, the one that will keep you in the game long enough to succeed, is the 1% rule. This means you should never risk more than 1% of your total account balance on any single trade. Let's say you have a $1,000 trading account. 1% of that is $10. This means the absolute maximum amount you are allowed to lose on one trade is $10. This rule ensures your survival. Even a string of 5 consecutive losses would only reduce your account by about 5%, leaving you plenty of capital to continue. But just limiting your losses isn't enough. You need to make sure your wins are meaningful. This is where the risk-to-reward ratio comes in. You should only take trades where your potential profit is significantly larger than your potential risk. A ratio of 1 to 1.5 is a good starting point. This means for every $10 you risk, you are aiming to make $15. This is how profitable traders make money over the long run. They ensure their winning trades more than cover the cost of their losing trades. This gives you a powerful mathematical edge. With this 1 to 1.5 ratio, you only need to be right 40% of the time to be break-even. Think about that. You can be wrong more often than you are right and still not lose money. If you can get your win rate up to just 50%, you become consistently profitable. This is the secret. It's not about winning every trade, it's about having an edge that pays off over time. Now, let's cover the psychological traps. The number one mistake, without a doubt, is revenge trading. This happens after you take a loss. You feel angry and frustrated and you want to get your money back from the market. This is a recipe for disaster. You abandon your trading plan, ignore your risk rules, and start gambling, which only leads to more losses. When you feel those emotions after a loss, stop. Walk away from the screen and come back when you are calm. The second huge mistake is not using a stop loss. A stop loss is an order you place to automatically close your trade if the price moves against you to a certain level. It is the practical application of your 1% rule. Many new traders avoid them, hoping a losing trade will turn around. This is wishful thinking. A stop loss is not your enemy, it's your main safety feature, it's your seatbelt. It takes the emotion out of cutting a loss and protects you from a catastrophic blow-up. Every single trade must have a stop loss, no exceptions. So, there you have it. We've covered the absolute basics of what Forex is. We've defined the key terms, and we've walked through a complete, simple strategy you can start practicing today. You now have a clearer roadmap than 90% of people who dive into Forex without a plan. You are already ahead of the curve. The journey ahead won't always be easy. There will be losing trades, and there will be moments of doubt. Every single successful trader has gone through this. Don't see trading as a series of individual wins and losses. See it as a long-term game of probability and discipline. Your job is to execute your strategy flawlessly over and over. Your first step is not to fund a live account tomorrow. Your first step is to open a demo account. Set up your charts with the 2 moving averages we talked about, and start practicing. Commit to the process. Be patient with yourself. You have the tools and the knowledge to get started the right way. The potential of the Forex market is immense, but it only rewards those who approach it with respect and discipline. Your journey starts now. Take that first step. I wish you the absolute best of luck.